This chapter 2 describes share buybacks in their cash and synthetic forms, including some of the complex regulatory and accounting issues that relate to these instruments. A company's decision to repurchase common shares, which ordinarily requires board approval at least, may be driven by a number of considerations. Management may be seeking to increase the company's leverage in order to enhance EPS and possibly lower the company's WACC, especially for entities that have arguably too little debt. Management may be attempting to signal to the equity markets that it considers the shares to be underpriced, hoping thereby to encourage new buyers into the market and give a boost to the share price. Management may recognize that the company's industry is maturing and that growth opportunities are becoming scarce, justifying a decision to return profits to the shareholders instead of reinvesting them in new projects with diminishing returns. Management may be seeking to offset dilution anticipated in the future, whether from conversion of an outstanding debt instrument or from exercise of employee stock options that have gone deep in the money, or from some other source. Finally, management may wish to increase its dividend payout for any number of reasons, but is able to achieve tax efficiencies via a share repurchase that are not available through a simple dividend increase. We will dwell no further on the factors that motivate share repurchases and focus instead on how these can be implemented. We mentioned first that shares repurchased by their issuer are known as treasury shares and, until cancelled, appear on the balance sheet as a contra equity item rather than as an asset. This means that total equity is reduced by the value of the shares repurchased, whether or not those shares are cancelled immediately. Many limitations apply under local law to share repurchases. These are completely prohibited in some jurisdictions, subject to daily or periodic volume limitations in others, subject to blackout periods around the announcement of the issuer's results, and so on. Often, these legal constraints drive the structure adopted by the company and the precise mode of settlement, as we will see shortly. A cash-rich company can simply purchase its shares in the secondary market or by making a tender offer to all shareholders on predefined terms. A company that lacks the cash to do this, or that wants to preserve its cash for other purposes, may also issue debt in the market and use the proceeds to repurchase shares. More interesting for us are structures involving the use of equity forward purchase contracts. A company wishing to go long its common shares may simply enter a forward contract, under which the company purchases a specified number of shares for settlement on a specified future date at a specified price. Assume, for example, that the shares are trading at $100 in the spot market and pay a $2 dividend annually, and that the risk-free yield curve is flat at a constant 4%. the company could enter a forward purchase on 100 million common shares, settling in 2 years' time, for a price per share of around $104. This 2-year forward price is derived using a typical spot plus cost of carry formula. And specifically in this case, the forward is the spot multiplied by 1 plus the risk-free rate squared, because of the 2-year tenor here, divided by 1 plus div yield squared, where div yield is the dividend yield on the stock. So F equals this quantity here, that is $103.96, or just under our $104 from above. Note the following with regard to the forward contract. Pricing, of course, would be adjusted upward to generate an acceptable margin for the dealer, here the party selling forward, reflecting the risks of the transaction. One party or the other takes dividend risk under the current structure. An increase in dividends above the rate assumed in the formula generates a windfall for the forward seller, i.e. the dealer, and a loss for the forward purchaser, which is the issuer. Over short tenors, dividends can be estimated with reasonable accuracy in most cases, but less so over the long term, or in the case of an event risk affecting the issuer, such as a dramatic reduction in its dividend following a period of poor performance, or a change in the tax law. For liquid stocks, dealers can use dividend swaps to hedge a portion of this risk, but these are rarely available for less liquid or emerging market stocks. In such cases, the two parties may shift the dividend rate risk back to the issuer, who is, after all, the party with the ability to control the dividend yield to some degree, via an adjustment in the settlement price under the forward contract. Specifically, with the forward contract price diminishing roughly by the amount of any increase in dividends above the rate originally assumed, and vice versa if dividends diminish below that rate. The dealer under the forward contract is taking so-called wrong-way counterparty risk. Specifically, the lower the share price, the greater the theoretical gain he has under the contract, but the greater also the likelihood of non-performance on the part of the issuer, since a much diminished stock price would be accompanied most likely by a weakening credit condition. The counterparty risk from the issuer's perspective is less easy to describe, since no obvious correlation exists in most instances between the share price of the issuer and the financial condition of its dealer counterparty. Of course, if the dealer actually owns the 1 million shares from day one as part of its hedge, it might be possible to deposit these in escrow and thereby eliminate altogether counterparty risk from the issuer's perspective. The economics and cash flows of the forward, like any forward on any asset class, are substantially the same as those of a spot purchase with borrowed funds. The issuer has gone long his shares, economically speaking, but has maintained his liquidity until the settlement date. This matches the situation under a spot purchase of 1 million shares with $100 million of borrowed funds costing 4% in interest. The $4 million differential between the spot price and the forward price of the 1 million shares matches the $4 million of negative carry that the issuer would incur over 2 years if it borrowed $100 million at 4% and bought back immediately 1 million shares, on which the issuer would no longer pay the 2% in dividends. Furthermore, the end result in terms of shares outstanding is the same under either structure, namely a 1 million reduction in outstanding shares. But this takes place under the forward 2 years down the road versus immediately under a spot purchase with borrowed funds. This is not a trivial difference. For EPS purposes, the spot purchase with borrowed funds removes the shares immediately from the calculation of shares outstanding and therefore from the denominator of EPS, among others. While the forward purchase typically is ignored until settlement for EPS purposes, based on an accounting principle that requires the reporting company to ignore anti-dilutive instruments until they settle. The legal and regulatory perspective, unfortunately, is often inconsistent with the EPS accounting. Under most bank regulatory regimes, for example, including Basel capital regulation, the shares underlying the forward contract are immediately considered to have been repurchased, and thus are no longer included in the calculation of the bank's Tier 1 and aggregate capital. In some countries, a company is obligated to cancel any repurchased shares either immediately or after a specified period of time from the date of repurchase. In cases like these, companies are often attracted to the forward purchase alternative. By entering the forward, the company replicates the economics of an immediate purchase, as we have seen, without technically engaging in an immediate purchase and thus triggering the obligation to cancel the shares repurchased. Of course, upon settlement, the cancellation obligation would come alive, but the company has 2 years to determine another use for the shares and to preempt the cancellation obligation if it so wishes. Like any equity derivative, indeed any derivative on almost any asset class, settlement under the forward can be done in one of 3 ways, known as physical or gross settlement, net cash settlement, and net share settlement. These are described next. Under physical or gross settlement, on the settlement date, the issuer delivers $104 million in cash to the dealer, and the dealer delivers 1 million shares to the issuer. Under net cash settlement, the spot price on the settlement date is compared to the fixed price under the contract, and the difference is multiplied by the 1 million notional number of shares to determine the net settlement amount in cash, which may occur in either direction. For example, if the spot price on the settlement date is $94, the $10 difference between spot and the contract price represents a gain for the dealer So the issuer delivers $10 million in cash to the dealer. Conversely, if the spot price on the settlement date is $114, the difference of $10 between spot and the contract price represents a gain for the issuer, so the dealer delivers $10 million in cash to the issuer. Note that net cash settlement bypasses altogether legal, regulatory, and similar restrictions on company share buybacks, while continuing to offer substantially the same economics as we have seen. The accounting treatment is complex, however, and is addressed shortly. Under the third settlement alternative, that of net share settlement, the net loss in dollar terms is delivered on the settlement date by the party incurring the loss to the other party, but in the form of shares and based on the spot price at that time. Thus, if the stock is trading at $94 on the settlement date, the issuer owes $10 million to the dealer, which he satisfies by delivering to the dealer an amount of common shares equal to 10 million divided by 94 equals 106,383 shares. While if the stock is trading at $114 on the settlement date, the dealer owes $10 million to the issuer, which he satisfies by delivering to the issuer an amount of common shares equal to 10 million divided by 114, which equals 87,719 shares. We emphasize again that in the first of these scenarios, when the share price declines to $94 on the settlement date, it is the issuer who delivers shares to the dealer, even though the original purpose of the transaction was for the issuer to repurchase some of its outstanding shares. We mention finally that many transactions grant either the dealer or the issuer the choice between physical, net cash, or net share settlement, and that the accounting in such cases becomes even more complex. We complete this chapter 2 by reviewing the principal accounting rules under IFRS for own stock forward purchases. Reminding you first of the caveat we made earlier in this module, and specifically of the need to simplify rule complexity and avoid overwhelming detail. For further simplicity, we assume the stock now pays 0 dividend, that the forward is now a 1-year forward, that the trade and settlement dates are February 1, 2010 and February 1, 2011, respectively, that on December 31, 2010, the year end, the spot price of the stock reaches 110, and that on February 1, 2011, i.e. the settlement date, it falls back to 106. The fixed purchase price under the 1-year forward, of course, is 104 once again, based on our earlier equation. You will recognize readily that as of December 31, 2010, the contract has a fair value for the issuer of around $6 million, in fact, $6.35 million, and that on the settlement date, this fair value declines to $2 million exactly. The accounting entries on the balance sheet and in the income statement, however, are not so simple. and they depend on the mode of settlement. The principal and related questions are: first, whether to treat the transaction as essentially an equity contract or as one that generates an asset or liability that should be recognized on the balance sheet. 2, whether changes in the value of the contract between reporting dates should be recorded in the income statement. And 3, whether to take account of any shares issued or redeemed under the transaction in the calculation of EPS or diluted EPS. In what follows, and for the rest of this module, we will not necessarily use standard accounting terminology to avoid confusing those with little background in this field. Starting with physical or gross settlement, IAS 32 classifies the forward as an equity contract giving rise to a liability for the purchase price. Therefore, on February 1, 2010 at inception, IAS 32 requires the issuer to reduce equity immediately by the value of the shares underlying the contract, and to recognize simultaneously a financial liability in respect of the issuer's obligation to pay for the shares on the settlement date in an amount equal to the present value of the aggregate purchase price. In our example, this is exactly $100 million for both items. This treatment, in effect, acknowledges the economic and cash flow similarity we mentioned previously between the forward purchase and the immediate purchase with borrowed funds. With regard to the income statement, there is no impact from the transaction on day one. However, the interest that will accrue under the liability over time, as it accretes from $100 million on day one to $104 million by the settlement date, will be recorded in the income statement under the so-called effective interest method from IAS 39, with which you may be familiar. On 31 December 2010, therefore, i.e. at the year end, with 1 month only remaining before settlement, the income statement records an interest expense equal to 11/12 of the $4 million in aggregate interest that accrues under the liability over its life, i.e. around $3.67 million. We are assuming here that the issuer has not elected to have this liability accounted for through profit and loss under the fair value option permitted as an alternative. This reduces retained earnings on the balance sheet by the same amount. At the same time, the liability appearing on the balance sheet is adjusted on account of this accrued and unpaid interest from its original $100 million to $103.67 million, and the balance sheet continues to balance. What happens finally on the February 1, 2011 settlement date is understood most easily if we break it down into 2 steps. First, the liability accrues 1 additional month of interest, i.e. $0.33 million, which is recorded as interest expense in the income statement and causes the liability on the balance sheet to be adjusted one more time from $103.67 million to $104 million. At the same time as retained earnings are also reduced by this $0.33 million. Then 1 second later, so to speak, the issuer settles this liability by delivering $104 million to the dealer, for which the accounting treatment, affecting only the balance sheet this time, is to eliminate the liability under the forward and to credit, i.e. reduce, cash by an equal amount. The EPS treatment is easier. The shares underlying the forward contract continue to appear in the denominator of the EPS calculation until the settlement date. This is consistent with the principle that anti-dilutive transactions are ignored for EPS purposes until they settle. Note the obvious disadvantage this creates versus an immediate purchase of the shares with borrowed funds. Net cash settlement is handled quite differently. IAS 39 now classifies the contract as a financial asset or liability, to be recognized at fair value on the balance sheet and, with changes in fair value between reporting dates, recorded in the income statement as profits or losses under IAS 39. This recognizes the reality that net cash settlement may generate cash outflows or inflows for the issuer and no longer involves any transfer of actual shares. Assuming the contract has zero NPV initially, there is therefore no entry on day one on either the balance sheet or in the income statement. On December 31, 2010, i.e. at the year end, the fair value of the forward reaches around $6.35 million, a number you should be able to confirm easily. The income statement therefore records a gain on the forward in this amount, and the balance sheet recognizes a derivative asset also for this amount, with retained earnings increasing by an equal amount and the balance sheet continuing to balance. Finally, on the settlement date, February 1, 2011, the decline in the share price reduces the fair value of the forward contract to exactly $2 million, i.e. by $4.35 million, which is recorded as a loss in the income statement. Retained earnings on the balance sheet are reduced by the same amount, and so also is the derivative asset booked previously at $6.35 million, which therefore becomes $2 million. And 1 instant later, upon final settlement, the derivative asset is eliminated and replaced with $2 million in cash. You will not fail to notice that income statement volatility is far greater under net cash settlement. The denominator of EPS is unaffected by this transaction, including the diluted EPS. But the numerator, of course, is affected by the swings in the contract's fair value that are recorded in the income statement. The accounting treatment for net share settlement may come to you as a surprise. Even though settlement at the contract's maturity involves actual shares, IAS 39 still classifies this derivative as a financial asset or liability, recognized at fair value on the balance sheet, and with changes in fair value between reporting dates, recorded in income statement as profits or losses under IAS 39 as before. This is on account of the variability in the number of shares required for settlement, which of course depends on the spot price of the stock on that date. All entries in the balance sheet and income statement are therefore identical to those under net cash settlement, until the final entry when, upon settlement of the forward contract on a net share basis, the issuer debits equity by $2 million instead of debiting cash by this amount, as with our previous example. Many issuers prefer net share settlement over physical or net cash settlement, since it leaves the company's liquidity position unaffected at all times. Offsetting this to some degree is the risk of dilution that could occur if the share price is below 104 on the settlement date. More specifically, the calculation of EPS under net share settlement suffers once again from the asymmetry under IFRS that ignores anti-dilutive instruments until they settle, but requires them to be reflected immediately in diluted EPS if they are dilutive. In our actual example, the share price is above the contract price of 104, both on the year-end date and on February 1, 2011. The contract is therefore ignored for purposes of EPS until actual settlement, of course, since it is anti-dilutive. But if the share price had dropped to $80, say, on December 31, 2010, the denominator in diluted EPS for 2010 would increase by an amount of shares equal to this quantity here, i.e. 300,000 shares, where you will note we unfairly penalize the issuer by taking, in effect, the future value of the negative fair value rather than its present value. This completes our discussion of the accounting for forward equity purchase and brings us to the end of this chapter 2.